So the second protocol that we'll talk about in this section on credit and lending is Compound. And Compound is a very important part of the DeFi ecosystem. So what is Compound? So this is a lending market, and it offers many different ERC-20 assets for borrowing and lending. And interestingly, and we'll go through the mechanics of this, all of the tokens in a single market are pooled together. So every lender earns the same variable interest rate, and every borrower pays the same variable rate. Okay, so that's different than what we talked about with DAI. So there's obviously many similarities, and given that we're using cryptos, we need to think about over-collateralization again. Okay, so within this space, there's no credit rating. So people are not really identified, pseudonymous. So you don't really know who they are. They don't have a credit rating, and there's no way to send the collector if somebody is under collateralized. Okay, so this idea of rating is irrelevant within the space, and this is the reason that we have to have over collateralized lending. So this is, again, much different than the usual situation for everyday lending, but it is analogous, as I pointed out earlier, to a collateralized debt position like a mortgage. So if the borrower falls below the collateralization ratio, the position is liquidated, just like we saw with the MakerDAO. And just like MakerDAO, the liquidation can be done with a keeper, and the keeper is incented to actually check for situations where there's a liquidation opportunity, so where the collateralization ratio is pierced, and their incentive is a bonus to actually do that. So let's kind of go through collateralization ratios and factors. So we've talked about this a little bit with MakerDAO. We'll go into much more detail, and it's going to be a little more complex because we have multiple cryptos to deal with. So it turns out that every crypto within the Compound platform has got some collateralization factor. And these factors range from 0 to 90. So a factor of 0 means that the asset cannot be used as collateral. And as that factor gets higher and higher, the crypto is deemed less risky. So the safest cryptos would have the highest factors. So the required collateralization ratio is basically 100 divided by the collateral factor. Okay, so the ratio is 100 divided by the factor. And we'll, again, go through some examples to show you how this actually works. So again, the most volatile assets have the lowest collateralization factors. Okay, so if, for example, you've got a collateralization factor of 50, then the ratio is going to be 100 divided by 50 is 2. And we actually talked about a collateralization ratio of 2 in the context of MakerDAO. So this is a protocol where you can have multiple different types of collateral. So the way that we'll actually calculate the collateralization ratio is to look at a weighted average of these factors. And that kind of makes intuitive sense in terms of calculating across different different cryptos, which might be of much different risk. So for example, USDC would be very safe with a very high collateralization factor and a very low collateralization ratio. Whereas something like Ether, we know that's much more volatile. So the factor will be lower and the ratio higher. Okay, so we can actually think of this collateralization ratio like a reserve multiplier. And this is lingo from traditional centralized commercial banking finance. Okay, so essentially, the collateralization ratio is very similar to a reserve multiplier in traditional banking. Of course, in traditional banking, the banks need to take a certain amount of their deposits and hold that at the Federal Reserve or whatever central bank on reserve. So there's a limit in terms of how much money can be created in the system. Okay, so this is important in terms of how this system actually works. So let's go through some examples. The first one is an investor deposits 100 DAI, and DAI has got a very high collateral factor, which is 90, reflecting that it is very low risk. So it's pegged to the dollar, its volatility is small, so the factor is 90. So to get the collateralization ratio, that's really easy. We just take 100 divided by 90, and that comes up with a ratio of 111%. So this is basically saying that if the DAI is worth $1, then if you deposit 100 DAI, then you can borrow up to $90 worth of any other asset in compound. Okay, so again, if you deposit a safe asset, then you can actually borrow more as a result, because the collateral factor is so high. So let's again go through an example here. Suppose the user borrows the maximum and the price of the borrowed asset increases. Then we need to be cognizant of all of the components of what's actually happening. So we don't want to be subject to liquidation. So you would probably never actually go and borrow at the collateralization factor or rate at the ratio. And it's very similar to what we talked about with MakerDAO. It's too risky. A small fluctuation could cause the liquidation. Okay, so let's actually look at a different situation where it's not just 100 DAI that are deposited, but an additional deposit of collateral is put in with a 2 Ether. So Ether in this particular example has got a lower collateral factor, and it's going to be 60, which reflects the risk of Ether versus DAI. And let's assume the price of Ether is $200. Okay, so now we've got a total dollar amount of 500. So we've got $400 worth of Ether and $100 worth of DAI. Okay, so in terms of the weighted average here, 80% is in Ether and 20% is in DAI. So we can easily calculate the weighted average of the collateralization. So basically the collateral factor is just 0.8 times 60 plus 0.2 times 90. That's the factor. And then to get the collateralization ratio, we just take 100 and divide by the factor. And when you do that, you get 151% approximately. Okay, so this is an example of having multiple things that you're using for a collateral. And I've got a graphic that shows this. We've got the Ethereum, and the value of that is 400. The DAI, we've got 100 worth of that. And then I'm actually showing on this graphic the borrow liquidity. So if this was just Ether, so if it was just $400 worth of Ether, then the borrow capacity is $240. Or if this was just DAI, then the borrow capacity is 90. So when you put that together, the borrow liquidity at the maximum, and I'm not suggesting you would do this at the maximum, but at the maximum is 330. And again, if you do this, you look at the total collateral, divide that by the borrow liquidity of 330, you get the collateralization ratio, which is 151%. So this is just another way of working out what the collateralization ratio actually is, and a very intuitive way to do it.